These guards like to test you, though. They want to get hurt for $10 an hour. Don't get in the way.
Asset Secured, welcome back, guys. How y'all doing? I was going through my computer and I found what's called the balance sheet stock rules. When I was a new trader in the market and I started trading earnings and stuff, I devised a formula or just a set rules, guidelines, whatever you want to call it, in terms of just how to trade stocks. For me, at the time when I was a beginner, before YouTube and everything was going on, and just before so much information was available to us, and I made this list called the balance sheet stock rules, and I just found it on my computer. I thought I'd just share it with you guys in its organic fashion. Without any further ado, let's begin. So this is what it is: the balance sheet stock rules, and one of the first ones I wrote was, do not buy a small cap under $6. They can easily get delisted or a reverse split can happen unless you're an experienced trader or the stock is stable and profitable. Or other factors that you've observed, if there's a pattern, right? I mean, if it hit the resistance or the support 3, 4, 5 times and you've seen a set pattern, then you could go ahead and have a bang at it. But I wouldn't suggest this for new traders and new investors. Just be cautious when you're trying to buy into small cap companies. Look for stocks in emerging markets that has a well-known market leader. Example, Tesla. Stocks like Tesla, alternative energy. You want to look for stocks in emerging markets. Be very cautious of penny stocks with less than 20 employees, including board members. 20 employees, including board members. A lot of times, funny stuff goes on in the stock market. A lot of what you see isn't really reality. There's a game behind the game. So be cautious of everything that you see and you think it is what it is. Stocks that are active in pre-market generally drops minutes before opening. Be cautious of this. A lot of times, you see a stock going crazy in pre-market, and then the market opens and it dissipates a bit, it descends a bit. You know what I mean? It cools off a bit. You want to give yourself a buying opportunity, and sometimes based on information that's available, a lot of times a lot of people buy up a lot of shares in pre-market. When they get in the market, they sell off just because there was a pre-market hype. So you want to be cautious of this. Seek stocks that are based on future integration, culturally, financially impactful. Example, Shopify, Beyond Meat, Tesla, Microsoft, Apple, Zoom. Like I said, you want to invest into stocks that are future-proof. They're going to be around 10, 20, 30 years from now. They're going to be a part of the system that we're going to have. They're going to be part of the financial system, like I think Sophie, online platforms, Zoom, for example. You want to look for stocks they're going to be around for quite a while. Therefore, your money is safe. You know what I mean? They're going to rebound and they're future-proof pretty much. A good stock will have great fundamentals and market sentiments. Some stocks are built on ideas that may or may not have a prototype, but the stock still rallying due to it being interesting. Just one of those stocks that are, it's being talked about and it's just an interesting stock. It's an interesting venture, and the unknown makes it just super interesting, so it tends to rally. That sometimes happens in the stock market. The stock market's all about media attention, and the media sells stocks. When I say the media sells stocks, what do you mean by this? If you keep on hearing about Tesla and NEO and Amazon, those are called media darlings. They're always in the media, always getting media coverage, and this helps a stock tremendously. If you look at it, what has big media attention will move the stock relative to what the news is. If good news is being reflected about a particular stock, it's going to move in a positive direction. If there's bad news, it's going to move in a negative direction. Therefore, it's safe to say that media does affect the way a stock swings relative to the information that's provided. Events may affect a certain stock where it drops over consecutive days. Weigh these events and its severity among other unresolved events to determine the market psyche. You want to understand where the market's going. What is the market doing? Is it in turmoil? Is it a red day or a green day? You want to analyze all the factors before you make a play or get in a play or get out of a play. You have to just analyze these factors in its entirety before you make certain plays. Buying immediately after a drop may not be ideal in these scenarios. Wait and watch for at least a day or two just to see how the market's behaving, if the stock is rebounding, if there's any further information about why the stock dropped or why there was a sell-off. You want to always have information before you make a play. Let information and understanding be the driving force when you decide to engage in any trade or investment. In unstable markets, it's better to break even and reevaluate your position. Too much negative events within a company, country, global economy occurring all at once typically just erodes the progress of a company or stock. You want to be cautious of this. Like if you look at what's going on today, be it came out in 2021, there's a lot going on, and a lot of times economical factors play a huge role. Governments play a huge role in certain industries, and you want to be abreast of what's going on. You want to be abreast of the information that's being provided, and a lot of times just negativity on a whole in certain areas does affect certain stock tremendously, and you want to be cautious of this. When buying a stock, list current or looming distractions and weigh the probability ratio. You want to make high probability plays. That's it. You simply want to make high probability plays. That's all that's saying. You want to make high probability plays. You want to list the lumen distractions. The cons, the pros should outweigh the cons by mile and miles and miles. It should be 30-70. It should be 30-70 regardless. Stock earning purchases are risky. For a good earnings rally, the market has to be quiet with no distractions and positive earnings indicators. This is saying if you're going to be trading earnings, you got to know what's going on. You got to know the earning dates of your stocks that you're going to trade. You have to have some information that the stock's going to rally. You have to have some prior information based on prior earnings reports. Last quarter did this. You want to buy 10% every quarter or 5%. You want to have some good information and nothing's changed within the company, the structure of the company, and they've been pretty much the same. There's no distractions. That's all that's saying there. Stocks usually peak around midday and close lower. You know what? A lot of times you guys don't understand that. If you look at the trajectory of a stock throughout the day, it goes crazy about like 1, 11, 12, a little bit cool down at 12, and as the market closes, a bit of a sell-off. That's us, the day traders, we're getting out of the market. A lot of times the swing traders or the new traders that got in, they're still in that stock. So you want to be abreast of when you're getting in or getting out of a stock. Take profits out if you have hit your target price. Stick to the plan, guys. That's all this is saying. Stick to the plans. Always have an exit plan. Especially on earnings days. If you're trading earnings, always have an exit plan because it goes up because of earnings and then tomorrow's a sell-off. Retail stock jumps the highest across all sectors in earnings season. When they have beaten earnings, anytime a stock's beaten earnings, it goes bonkers. Pretty much, in most cases. Coupled with good future guidance. For example, Gap, Sifix, ANF. Be careful on earnings day. Multiple stock with good news, usually there is a main unicorn that gobbles up all the spotlight and media attention. A lot of times you miss what's going on because there's just this one stock that's trending and all that's going on with it. You forget about other stocks and you want to be abreast of what's going on. On a downtrend, buy shares on preceding days with signs of recovery. Never buy same day when a stock is trending down with no sign of recovery. You never want to do this. You only want to buy if there's some indicator, some sign, some information of this stock recovery. If you don't have information of a stock recovering and it's trending down, you can't say, oh, I'm buying at a discount. You have to have some information that says it's going to rebound, or based on this, or based on 3, 4, 5 patterns that you've observed, there's going to be a rebound. You never want to buy when a stock's trending down with no signs of recovery. I'd say invest around 35% of cash max to avoid downside lockup. This is just me personally what I did. Downside lockup if you're not a true trader or you don't have full understanding of what you're doing. One of the greatest mistakes I made was I seen a play and it looked beautiful to me at the time, and I would say 50% of my portfolio. One of the number one rule is to diversify your portfolio at all times. I put 50% of my portfolio, my investment capital in that one stock, and it blew up, and I lost 50% of my investment capital because I took a gamble. You know what I mean? At max, and this is just if it's really good information, you believe in it, super futuristic, it's been doing great. It's like at max, like absolutely just beautiful at max. It's like Tesla, it's a Tesla. You can put like max 35%. I wouldn't advise even 35%. I'd advise 25% of your portfolio. You never want to put so much in. You never want to put all your eggs in one basket. Watch pre-market and post-market trending to help determine stock market direction. You want to watch pre-market and post-market trending to see where it's trending, what direction is the market going. We spoke about that. Stocks below $5 small market cap hasn't established support. If they have little to no trust, usually don't jump the same rate as mid-cap stock that has already established trust. I guess that speaks for itself. Mid-caps move the highest on earnings or news on beaten earnings due to their reduced risk, and they have already established investor support. Scout new IPOs. They usually take a year or two based on prior 2020, when fundamentals and indicators and technical analysis is what we use to trade, like patterns and fundamentals at the time. Now the ball game's a bit different. I wrote scout new IPOs. They usually take 1 to 2 years to show a large movement in normal market circumstances. In speculative market, people rally to stocks that has a proven growth story. Doesn't normally include IPOs and SPACs. Example, PayPal, Shopify, Apple. People tend to rally to those stocks in a speculative market. Stocks with large volumes that has support. People like to park their money in stocks that has established support. When market declines, trusted stocks rebound the fastest. That speaks for itself. If a stock doesn't rebound within the market, it lost its support. If a stock, you know what I mean, it went down and it's just simply there's no signs of recovery, it just simply saying it's just it's lost its support. Mergers and acquisition increase stock price of a company being bought up by 50% in cash transactions. I don't know what I was saying there, but I'll see if I can remember and feed it to you guys here. Buy stocks in 25% lots based on movement. This is basically saying if you're looking at a play and the play looks nice, you never want to go in. You know, even if you're going to spend $1,000, I'd say let's get in with 250, $300. You can scale your way in. You never want to go all the way in. You just want to analyze and get in slowly. This is just when I was new, like I said, and I really didn't understand all the aspects of trading, the styles of trading, just everything's entirety. This is just like a safety net of you guys just securing yourself and having that level of control and understanding when you're investing, just to guide you. The lesser this amount, the more opportunity to reduce risk and to tie up cash. This gives you more opportunity to make moves when they appear. Be careful when selling a recovering stock. You might sell when it just starting to rally higher. A lot of times you've been in a position and you just got frustrated and you just sold out of the position without doing any research just because your money's been tied up for so long. You want to always do research before you sell and before you buy. In a market rally, if a stock lags behind in recovery, that's a sign that it has been eroded. Example, categories. We spoke about that already. Analyst ratings affect a stock tremendously. If a stock that has a buy or outperform rating that does not perform to expectations, this will likely affect the ratings in a negative manner. It will lose its positive rating. It's better to look for losers with a good books balance sheet, for example. You want to look for losers with good balance sheet, good fundamentals. A lot of times based on, and future relevance also. A lot of times there's a bit of a sell-off and you can always buy at a discount if it is a bit of a sell-off and it's a profitable company and just for whatever reason it was a sell-off, you know, this provides a buying opportunity. Find them before they start winning. Search for top 50 to 100 daily losers that has good fundamentals, future relevance. They may rebound within a day or so. This gives you a chance to buy at a discount. Find out why they dropped, and if there wasn't anything significant, then place strong consideration into buying these stocks, because if everything looks good on the books and it's a mere sell-off like we said, this provides a good buying opportunity. Buy stock as futuristic outlook. Stocks that are not developing or changing, aligning with the future developments, will die out in most cases. Example, BlackBerry. But it's BlackBerry's having a comeback. But when they were making their phones, they weren't innovative enough and they died out. That's pretty much what that's saying. Companies that are in the business of human interaction are normally good future investment in most cases. For example, Snapchat, Facebook, Instagram. Attention. Everything's about attention right now. YouTube. Companies that can grasp attention and they're in the business of human interaction. They tend to be good investments. Earnings forecast may be an opportunity to buy a share early or buy in cheaper when earnings are missed. Large brands tend to lose large percentages on if earnings are missed. A lot of times if earnings are missed, you'll see a huge sell-off. We spoke about that. But usually rebounds after a day or two. If a company is established, it's gonna always rebound. It's just gonna simply always rebound due to a cheap buying, because it's gonna provide a buying opportunity. I wrote that a lot of times. Know the earnings dates for all the stocks invested in. This can affect your portfolio substantially. Future outlook for earnings is a very important driver in the stock price. For example, ANFQS. Along with beaten earnings substantially, companies that provide products for women usually performs better in sales. Observe women in culture and find those companies. Stocks within the same sector affects each other. Examples, i.e. ANF influence AEO 5% stock increase before day of earnings. Stocks in the same sector, XPIV, NEO, Tesla, if one's doing well or the sector's doing well, they tend to pull each other. Best to buy one day ahead of earnings if there's good intel that they will beat earnings. This gives you time to get in early, but also gives you enough time to sell before earnings if new information comes out prompting doubt. Sometimes earning dates are not fully right based on the source that you get it from. You want to always get earnings dates from the company itself, official source. When the government has problems, this affects the market substantially. You will usually drown out all the good news about a company. Company news is as good as the time is presented. Timing is key, and in order to find the key, you need information. Otherwise, how do you know when to get in or out? Break these rules, pain will be optimal. Follow these rules, and a winner you'll be. Like I said, this was just some of the rules that I wrote when I was a new trader, when I was just developing my craft, developing my skill. And I just thought about sharing that with you guys. it's something to keep in mind. I place a lot of emphasis on earnings. Like I said, I was doing a lot of earnings at the time, and it did me well until you grow and you gather more experience. And the learning curve for being a trader, I'd say it's a year, 2 years minimum to be a proficient, profitable, being a 10% winning percentile. I say 90% of traders lose money, and that's certainly true. I'm not here to sell you guys a dream. You have to learn and put in the work. Until I see you guys again, this was the balance sheet stock rules. Asset secured.